Hi, good afternoon. As I tell my friends when they come to Chile, if the earth shakes, do not run. Wait a bit. Not unlike our earthquake risk, our being in the ring of fire, the global financial cycle is also very hard to insure against. And I think this year's conference is precisely occurring at a moment when global financial tensions are significantly elevated. Although the last couple of days have seen good news, particularly on the inflation front, let's just hope that they persist. Supervisory and regulatory authorities need, of course, to be on top of these developments. It seems quite a long time ago when the main concerns in the insurance industry were low interest rates and longevity risk and secular stagnation. It seems the macroeconomy of the Phillips curve is alive and well, and now we've seen high growth, high inflation, higher interest rates. In the most recent months, we have seen an external macroeconomic scenario has deteriorated. Risk for global financial stability remain high. There's been a very sharp rise in inflation across the world. This due to both supply and demand factors. I think that the fact that it has been suffered by everybody shouldn't be a comfort to the few. This is a phenomenon that has many common factors across the world. Global growth prospects have weakened, and there's been an increasing risk of a global recession going into 2023. Financial conditions undoubtedly have tightened. The dollar cycle and the Fed tightening and decisions most recently have propitiated a cycle of global strengthening of the dollar and increased the sensitivity of the financial markets to new developments. Here, most central banks have had to accelerate their interest rate hikes, with the Fed's actions standing out. In Latin America, maybe because of the lessons of the past, we started the hike early, and we also finished early. So maybe in comparison with other episodes, we are better placed now to see what goes on going forward. This tightening has, in the case of Chile, also led to a persistently weak exchange rate, along with high foreign exchange and interest rate volatility. The peso has depreciated around 15% during this year, and long-term interest rates have increased only by 26 basis points. Compared to the pre-pandemic environment, when Chile ranked low in interest rate volatility, now we're moving towards the average of emerging economies. This greater volatility also has occurred in a context of a shallower capital market with a reduced ability to stabilize external shocks and a higher than historical uncertainty. In this environment, financial stability becomes even more relevant, as does the need to keep our efforts to ensure financial markets well-functioning and shock-absorbing capacity well. In Chile, local authorities have continued to work towards the consolidation of a financial stability and macroprudential framework. And let me just give a few words on that. On the financial stability policy, the mandate of the central bank includes ensuring the normal functioning of internal and external payments. And we read this as giving us a broad interest on the stability of the overall financial system. And we've started doing financial stability reports and stress tests for already a decade and a half or even more. The CMF mandate is to safeguard the proper functioning, development, and stability of the financial market, supervising banks, their subsidiaries, large saving and credit corporations, credit card issuers, and most importantly, insurance companies and securities issuers. Strong coordination is required. We have a Council of Financial Stability, or a Financial Stability Board, where the central bank, the Ministry of Finance, the CMF, and the pension regulator all sit and share information. The consolidation of the macroprudential tools have been incorporated through several legal amendments. The central bank, through the improvement of the bank law, is currently able to potentially use a counter-cyclical capital buffer. We have had 2 meetings already this year where the board has decided not to activate this. The countercyclical capital buffer essentially aims to bolster the capital base of banks to increase their resilience, and we have mostly three criteria that need to be fulfilled in close coordination with the CMF. On the one hand, there has to be an assessment that the credit cycle is in some way indicating excess exuberance from the part of the banking lenders. This is not the case. Today, leverage is actually going down, both for households and firms. Second, there must be a sense that high risks have been increasing. This is actually the case today compared to, let's say, 1 year ago. And third, the application of systemic stress tests needs to indicate that the capital base of banks could be reinforced. Thankfully, the application of these stress tests has shown that the buffers that banks have seem to be sufficient to withstand even severe stress scenarios. The insurance sector plays a key role in the financial sector in Chile. Mature insurance industry, as was described by Minister Marcel, they have a relatively high size in relation to other economies and have an active participation in our domestic capital markets. As was mentioned as well, it plays a key role in the pension system through life annuities. However, gaps remain. International experience shows a clear trend towards a risk-based supervision in the insurance sector. Reference jurisdictions such as Australia, Canada, and the European Union have adopted this model long ago. Full adoption of an RBS framework requires a change in our legal framework, and a bill was introduced close to a decade ago in Congress that looks to establish such a model, considering, among other things, risk-based capital requirement, a new solvency assessment system for insurers, and a more flexible investment regime, among other changes. Both the central bank and the CMF have noted repeated times the relevance towards moving with this bill, labeling it as a high priority from a systemic point of view, considering the insurers' relevance and interconnectedness, as well as their significant participation in financial conglomerates. Despite the progress made by the CMF and the evolution of the industry in terms of risk management and corporate governance enhancements, moving towards a robust legal framework based on risk-based supervision is critical, and we look forward to this happening in the future. Let me conclude. A deep capital market remains critical to economic development and also to ease macroeconomic adjustment in the face of global shocks. In our case, this has been true in past events such as the global financial crisis and also the commodity supercycle. The unfortunate shallowing of our domestic capital markets over the past few years has deteriorated its ability to play this role, and also it has deteriorated the access of firms and households to long-term finance. This puts into focus the very critical need to reestablish long-term savings in Chile, as well as ease the function of our markets. We believe in the central bank that the recent proposed legal changes, including the resilience bill, as well as was mentioned before in the pension reform that aims to increase long-term savings, are welcome and should improve the functioning of our capital markets. With that, I hope you have a good seminar, and thanks a lot.